Hey, Kevin here, top 1 financial advisor and best-selling author, and we are here to talk about the stock market. Boy, we got some news out of Google. I'm feeling great because one, it's exciting news. I get to come out and talk about stuff and explain stuff because I know y'all gonna have these questions. But also, I'm looking right so far. It's early, but I'm looking right. I told y'all, I think this was end of 2019 going into 2020, and especially in 2021, I said that Google, it was a stock at that time that nobody was talking about. One of my best picks. I said it so confidently that I put it in the 2021 investing yearbook that we did a few years back. I've been talking about it. I've been saying it. I kept DCAing. Y'all see me investing in it on a regular basis on public. This is why. We saw the revenue jumped, I think it was 35% over the quarter, which is incredible. But here's the headline thing. They are doing a 20-to-1 stock split. That is huge. So right now I want to explain, like I did with Apple, as well as Tesla, what is a stock split? What does it mean for you as an investor? Is it a good thing? Is it a bad thing? How are things going to work? When is all this stuff going to happen? All right, so a stock split is when they take the price of the company and split it by that many times. So for example, I don't know what the exact share price of Google is right now. It's 25 or 2,700, somewhere between there. It's expensive. Now, if you own fractional shares like I do, you don't have to own full shares. You don't have to. So what they do sometimes, they look in the minds of investors, if it's a $3,000 stock, like Amazon, if it's a $2,500 stock like Google, they say, look, let's split it, let's make it feel cheaper for investors. It is not a benefit or loss to me. I already own shares. If you already own shares, it really doesn't matter. What will happen in July, and I'll get to that in just a second, is basically you take that stock price and you divide it by 20 and you get 19 more shares if you own one. If I own one, I get 19 more, and I have 20. Okay, so a 20-to-1 stock split. Basically, based on today's price, and this will obviously change, if I have one share, now I'm going to have 20 shares for, let's say, $130, $128, compared to one share at $2,500 or whatever the price is. That's it. I do not make or lose money by a stock split. I do not make or lose money by a stock split. It is only cosmetic. It is changing the color of the car. The engine is still there. The gas you got in the car is still there. That's it. I say that because in July, somebody's going to hop on some app and get up here and complain and say, I lost 50% in Google and all I did was buy it. What they did was not watch this video. I'm telling you now. What they did is not watch this video. This first time they did a stock split, they didn't read on the company, they didn't do any research, and then stock split hit them. Just like we saw this with Apple and Tesla, it will look like you lost a lot of money overnight. You did not. Give it a day, the app will correct and tell you what your current profits are and how the stock is performing. Okay, because what you're going to see is 2,700, 2,500, whatever it is, goes down to 128. You didn't lose any money. I repeat, you did not lose any money. Okay, want to get that out there. Okay, and it doesn't benefit me as an investor. It doesn't benefit or hurt me. However, in the long term, here's how stock splits have gone in the past. I'll put up a chart of Apple. I'll put up a chart of Google in 2014. Google has split before. It split in 2014, and they did like a special split in 2015. And essentially what this is within the first, I would say, month or so, the stock tends to kind of fall off, tends to take a dip. I don't know why, and then it starts to take off after that. Studies have shown that within the year after the split, so not in the year of the split, the year after the split, stocks tend to perform about 8% better than the overall stock market, which is good. And we kind of saw this with Apple. We kind of saw this with Tesla. When Tesla and Apple both split in 2020, those first few weeks or so, I was like, wasn't all that great. And then after that, I was like, oh, look, things are going quite well. Remember, in 2020, when Apple and Tesla split, both kind of fell. And then months later, it wasn't immediately, months later, the stock, especially for Elon, hit an all-time high. Elon was the richest dude in the world for quite some time. And then, we hit some other rough patches in the market. So I'm telling you that right now as well. Whether you are buying in tomorrow, whether you are DCAing into it, what have you, you may lose a little bit in the short term and gain in the long term. Now, the reason why some stocks tend to do well in the year after the split is because of traders. And what do I mean by traders? Traders are people, myself included, I do just a little bit of trading, not a whole bunch, is where you get to buy and sell shares pretty quickly. When you are trading, you usually have to have whole shares. When we talk about option trading, this is, you're buying a contract on a stock, not the stock itself. They're usually sold in blocks of 100. It means you have to hold, or it gives you the power to buy or sell 100 whole shares, which means that if I need to buy 100 whole shares of a stock that's $2,700, that's a lot of money. But if the shares are cheaper now and it's $130, $125, it makes it easier for me to trade. It makes it easier for me to buy up 100 shares. I can do that. I can do 100 shares at 125. Do 100 shares at 2,700. That's rough. Right, that's a lot to do, right? Especially not even just for regular average traders, but even people who've got decent sums of money. That's a lot of money to buy and hold 100 shares or more when a stock is that expensive. So bringing it down helps traders. Bringing it down makes it seem cheaper, even though technically it isn't because you have more shares. It doesn't make me any difference if you cut the same pizza in 8 slices or 16. It's the same pizza. It's the same. You made more of it, but it's still there, right? So cosmetic change, it doesn't really change anything of the company. It doesn't make the business any better or worse. Now your question might be, well, should I buy it now or should I wait for the split? My answer to that would be, if you thought it was a good company yesterday, if you thought it was a good company last week, then you should have bought it then. If you still think it's a good company, you can go ahead and get it now, but this is a long-term holding for me, and y'all know this. And the way that I view this is I would say maybe even the next 3 weeks or so. The way the past has shown us is not a guarantee of the future. However, the next 3 weeks or so, that's probably gonna be your best buying opportunity, because usually it tends to dip. This would be my buying opportunity. I would buy it and hold it for a long term, and hopefully things continue on the path that it should. Now, the other thing here is they did announce earnings. Those earnings were positive. I would expect Google to continue to rise. That's not a guarantee, because remember, they're still in the tech space, and tech, from what we've seen and from pretty much what we've heard, right, in terms of rising interest rates, is not supposed to help tech companies. I think Google is an exception to that rule because they've been around since 2004. We know they're making money. We just found out how much money they were making. And I don't see that changing, which is why I wasn't going to sell Google anyway. I was going to keep it regardless of what was going to happen. So yes, I like Google now. I like it tomorrow. And I'm not going to change that, right? So if you think Google is good, don't buy it for the split. Buy it because you think it's good. Because in reality, whether it was $2,700, $3,000, $2,500, you can still get fractional shares anyway. It's still going to help you, which is why I was buying it. I don't even think I have a full share of Google yet. I think last time I checked anyway, I had like 0.8 something shares. So I still don't even have a full share. I will when they do stock split, but again, I'm gonna have the same money in the stock in either case. So again, it's cosmetic. It is not a benefit to you to wait for the stock split or to buy it now. If you think it's a good company, just buy it. And then again, it usually takes a dip in the first few weeks, then it starts to be fine after that. And again, it's going to happen on people who own the shares by the end of the day on July 1st. By July 15th, that's when you're going to see that adjustment. So July 15th, put in your calendar to not worry about what's going to happen with that particular stock. Again, July 15th. If you have it by the end of the day on July 1st, according to CNBC, July 15th is when you're going to see that change. Do not be concerned. Put in your calendar right. I'm telling you, put in your calendar right now. Don't come for me in the comments when you see that Google dropped some crazy, ungodly percent. You didn't. It was a stock split. I'm telling you now. Okay? All right. That is it for me. Breaking news. Like, subscribe, do all that stuff so you can learn more. If you had any questions about this stock split or anything that's out there, feel free to drop that in the comments below. And I'll see you guys later. I need to, edit and push this out because this is breaking news. This is what I do. This is the fun part of my job. All right. That's it for me. Talk to you guys later. Bye.